now we're seeing even traditional developers coming to us looking to acquire deals that they've never done before in the past, right? So you do see that a little bit of that shift.
If you look at Arizona, and I think we can do better, but I think Arizona compared to a lot of other states from just a competitive edge perspective, we are predictable, low regulations. Yes, it's hard to get zoning approved for certain things, multifamily, certain cities, but for the most part, low regulation.
Our companies, major corporations, it's not just the tax breaks, though. Is there something about Arizona or Phoenix specific? We're sitting in Scottsdale, Phoenix, MSA. What's next for Phoenix, and where do we play? JC, we just had the privilege. We had a nice large team. Went up to Vegas. We had pretty much the entire world of multifamily transcend in Vegas, and for Apartmentalize.
Sure.
And we learned a lot. And one thing that I think both you and I said this too, just in passing, because we were going in all different directions. There are still a lot of eyes on Phoenix, which is great. Good and bad. I mean, a lot of us talk about, everyone wants to know about the supply, what's happening here. But let's talk about what remains for multifamily, specific to investors, owners and investors. So give me a couple key factors that's driving Phoenix's strength when it comes to multifamily.
Well, I think you have to go to a period of time when you think about, how was the macroeconomics influencing Phoenix, microeconomics here in terms of regulation, taxes, environment, economics, all of those things, and kind of break it down. So what are the, I'll say, tailwinds, regardless of the ebbs and flows of supply and market conditions? So forget fundamentals for a second. So why is the state doing so well from an economic perspective? So I'm going to go through, I have a bunch of notes.
Please.
And I just want to target a few things. So one thing to note, and I would ask the audience to go check out Danny Seiden's recent article. I think it was posted a day or two ago. He's the president and CEO of the Arizona Chamber of Commerce and Industry. I think he just celebrated his 4th year. He's doing a tremendous job and talks about how there's a lot of, not a lot, but there's some narrative around the anti-growth establishment, right?
Sure.
We're putting too much pressure on our infrastructure, on our housing, on our water supply. And if you follow the data, that's just simply not true. And, really for Arizona to be successful and thrive long-term, it's through economic growth. So I'm going to list some things that are really creating that tailwind, as I mentioned. So one would be, if you think about just the innovation, Arizona as a whole is becoming a center for technology. That's not just domestically, but also internationally. You think of things like the innovation hubs, such as Phoenix Forge, the Center for Entrepreneurial Innovation, CEI, LabForce. All of these groups are creating this Silicon Desert type feel, which is fascinating. And it's really pairing, I'll say, universities with really talented, I'll say, students, delivering that into the employer supply chain. So it's really merging well. Not to mention the proximity to one of the best universities in the country in ASU. Right now, I just pulled this data. Zillow ranks Phoenix or Arizona as the #1 best market for new college graduates. And, that's just, I think if you're trying to entice talented, hungry, strong demographics, that's a piece of it. You got to have strong universities and innovation. So that's one piece. I would say that employer migration has been something that's been truly a focus of GPEC and Chris Camacho's group, and obviously Sandra Watson and ACA. So if you just look at the numbers, and I'll share some with you, we continue to attract all of the major categories from a sector perspective that you want: semiconductors, bioscience, aerospace, clean tech firms. All of these things are bringing true value and GDP growth to Arizona. And then if you just look at, and before I get into some of the specifics and the headquarters that have been announced, if you just look at the high value sectors, and you look at the diversification of the employment base, in 2005, and I just did a comparison to, I think the most current data I have here is like 2023. But in comparing it, it used to be very construction heavy, right? Very dependent on construction and real estate. If you look at it today, if you just look at the difference in jobs in Maricopa County, healthcare, social assistance up 312,000 jobs, professional, scientific, technical up 200,000 jobs, manufacturing up 137,000 jobs, and we're on the early stages of that as we construct into those full-time jobs. And then transportation and warehouse up 4.8%. I don't have the specific numbers, but you can see that with the growth along the 303. You know, you throw in the mega projects like TSMC, Intel, Amcor, all these things are magnets in terms of headquarters and attracting suppliers.
Axon as well.
Yeah, all of those. So, right. Yep. So, if you look at GPEC specifically, their win-loss ratio is tremendous in terms of competing against other states. And since 2020, they've had 31 headquarters actually move here to Phoenix.
That's big.
And then there's 2 more this year. Dutch Brothers just announced they're leaving Oregon, no surprise, and Comtech. So, you know, that list continues to grow, and that's creating some strength. And then if you look at statewide, Arizona Commerce Authority, I just looked at their recent report. They have 482 active projects, meaning employers looking to move employment bases, not necessarily always headquarters, but moving employees, office space, translating that into Phoenix specifically. So that's truly exciting. And if you look at the international trade records that we had in 2023 and 2024, $32 billion in 2024, up 12% from 2023. So the GDP, the exports, the international connection is strong. And then, you know, part of that, going back to the education, I want to just touch on some of the success of ASU because that's been a tremendous lift, right?
Big.
You know, I think Michael Crow has been focused for a long time. He wants to create a knowledge-based architecture for ASU, and he's been doing that. So ASU is ranked #1 nationally in innovation, U.S. News, ahead of Stanford, MIT, Caltech for 10 straight years. That's impressive.
Amazing. Yeah.
So they just hit almost $1 billion in their research for their annual research funding. So that's close. That's top 30 in the country. And then bioscience trends, Phoenix ranks #1 in growth of biological and biomedical science, 5 of the last 6 years. Statewide STEM, I mean, the STEM program, #4 in graduates. So all of these things are really propelling us here. And then I'll just kind of end on a couple things with regulation. You know, regulation, it's really, if you look at Arizona, and I think we can do better, but I think Arizona compared to a lot of other states from just a competitive edge perspective, we are predictable, low regulations. Yes, it's hard to get zoning approved for certain things, multifamily, certain cities, but for the most part, low regulation and being business friendly. I think about the reliability of power. We clearly have a power issue as we build data centers.
Sure.
AI starts to take off in an exponential way, as it has been. The grid for Arizona ranks 7th nationally with only 6 weather-related outages from 2000 to 2023. So 6 times in 23 years. That's a pretty strong number. And then our diversification, right? So we have nuclear, natural gas, hydro, solar, all these things are contributing to that. And then you just look at taxes. Ducey and the legislature did a nice job of moving to a 2.5% flat Arizona tax. We have a very predictable tax structure. Corporate income tax is capped at 4.9%. There's no franchise tax. There's no inventory tax. So, you know, all these things are contributing to businesses saying, yes, pro-Arizona, pro-Arizona. So long story short, we're really seeing the fruits of all of the work we did from really the GFC into 2022, 23, and we're seeing that compounding into success here today.
You mentioned ASU. It wasn't that long ago where ASU was the brunt of many jokes, late night television, the party
90s,
school.
that's right.
Right? 90s,
That's right.
even early 2000s. It's amazing that turn. I mean, you've talked about it a lot, but it's amazing the turn that they've made. And to carry that 10 years in a row, that's fantastic. So a quick question regarding the economic climate again. Are companies, major corporations, It's not just the tax breaks, though. Is there something about Arizona or Phoenix specific? I mean, the weather's fantastic.
I mean, everything I just listed.
Everything, right? I mean, it could just keep on going and going and going. So
Yeah, you could. I mean, you could add obviously the weather, Sunbelt states,
and affordability.
affordability. What I think is often misrepresented, at least in the local press, is that Phoenix is not affordable overall, Phoenix Metro.
Right.
And you could say compared to when, sure, let's break that down specifically. But if you look at the top 30 metros across the country, Phoenix is the 18th most affordable.
Right.
So that's do you have to live in a brand new Class A in North Scottsdale? Not necessarily.
No. So many options.
But it is affordable when you compare it across the country.
So many options.
Which many of our, as we know from a demand perspective, our search tracking data shows us that there's a lot of folks looking from other states, more expensive states.
Right. So, not to focus in on in-migration or anything from our neighboring states, we talk about the amount of supply coming that is here, right? And it's been here for a little while, and it's going to continue through this year into next year. Let's talk about one specific vertical within there, and we've talked about this before. It's the BTR SFR townhome product. We've been pretty much ground zero since the start going 2017, 2018. What makes Phoenix such a prime market to have such a big boom specifically for that product
Yeah,
type?
it really goes back to the mid 2010s, and we were drastically undersupplied. So really from 2011 through 2023, November of 2023, we were undersupplied. And BTR developers were able to capitalize on that, specifically in the West Valley with affordable land and low cost to construct, all of those things factoring. And there was no new multifamily in the West Valley specifically, really at all, past 2008. And you had I wouldn't say a single family for sale housing shortage, but you had limited supply in specific areas. So all of those things were confounding, along with in-migration from California and other states. So you had a lot of population growth. You had almost, I'll say, perfect timing with those first deliveries of BTR. And if you remember, the narrative was early on, BTR commands 35% more rent than multifamily, traditional.
I remember that.
So that storyline, that topic line, hitting the press time after time, social media,
Light bulbs, everything. Yeah.
So you had a lot of capital starting to focus in on Phoenix, and that created a tailwind that was unlike any other from a BTR perspective. So you had a bunch of capital flood the market. And Ivy Zellman called it out. She said there was $80 billion chasing BTR at the point where we're starting to get saturated, and it was still coming. So you can see that as a result. You can see a lot of BTR in the West Valley because of that. And in reality, as multifamily started to catch up, as we started this new supply wave of deals,
Right.
multifamily and BTR, you started to see that start to balance out because no longer was a brand new BTR building sitting next to a 2004 garden style.
Right.
Now we have competing product that was in similar vintage. So that really changed the landscape. But today, I think it continues to offset the lack of single family transactions from a for sale perspective. So it's also affordability. So I think the piece that really helped push BTR absorption faster was that you couldn't buy a home because it was a $1,400 delta between your monthly rent and what you'd pay for that actual home, not even including expenses and cost of upkeep.
Insurance, et cetera.
So those were things that really propelled BTR to be what it is today in Phoenix.
Didn't hurt that we have a tremendous amount of land, considering that it's low density type product too, right? Yeah, definitely helps. You okay talking about data?
I love data.
A little bit of a sarcastic
I'm going to close.
question.
If we're going to talk about that, I can close this.
Yeah,
Let's go.
exactly. I got the data junkie extraordinaire sitting right next to me. So let's talk about what's the metrics that are important for investors when it comes to the Phoenix market today. Do you want me to start asking you questions, or you just want to start listing them right off the top of your head?
Ask questions.
Let's talk cap rates.
I want to stay in tune with you.
Let's talk cap rates. Why are investors so focused? Of course, one of many when it comes to cap rates. Let's look at occupancy, and then maybe even potential of having a little bit of rent growth come back to us soon.
Yeah, I mean, it's all about valuations, right? So it's also about leverage. So if you're buying at a 4.75 cap, we'll just say it's 4.75, easy math. but you can't get a loan for below 6. So you're buying with negative leverage. That's difficult, which is one thing that's slowing down the transaction volume. Not only the uncertainty of the market, the tariff back and forth in terms of that whole narrative. I feel like, unless you're a cash buyer, it's difficult to swallow a 4.75 cap rate.
Right.
So I'd say, Phoenix has been bouncing around between 4.75 and 5 at the A space level. And until we see a shrinking of sorts in terms of the spreads and/or the actual 10-year goes down, Powell cuts rates, you're going to see limited transaction volume because, to your point, if you add in the actual conditions of the market from a fundamental perspective, meaning occupancy is lower than historical averages today, it's below 94% for stabilized. I'm saying market wide.
Sure.
You have rents down 3.5% year over year. You have concessions exploding into 8 weeks, 10 weeks, 12 weeks free. So all of these things are difficult to plug into your investment model, your 10-year plan, and show an exit that makes sense. So those are things that are also hindering transaction volume.
How much does current absorption, all of the new units come into the market compared to, of course, excess inventory, two separate items, of course, and most do not pay attention to excess inventory.
No, I mean, it's easy to get caught up in the net absorption, right? 30,000 units, 18,000 units, whatever people say last
Right.
year. I think the reality is you have to understand that when you're delivering new units to the market at the pace that we are and the level, that you really have to look at it in two buckets. So think stabilized assets, historically 94% occupied in Phoenix Metro.
Right.
So today we're about 92%, depending on what data you read. So below that, that means we're oversupplied, right? And then you or factor in the second bucket, which is lease ups, brand new units. I think of it as, and what we like to say is, and you know this, we think of 2021 through 2027. We pick that specific time frame because of the delivery cycle. There's 97,000 units being delivered during that time frame. We've delivered 66,000 of those 97, so about 31,000 units still under construction, not yet delivered. And the key there is that only 76% of those units delivered are occupied. So you have about 10,000, if you do the math, about 10,000 units of excess inventory, which you mentioned.
Yeah.
Excess inventory is just brand new units delivered from a lease up, never been rented,
Right.
sitting vacant saying, come rent me, right? Come rent me. So that puts a lot of pressure on the market from an absorption perspective. So going into absorption, we've basically been in the band of 70 to 80% absorption of new units. And again, this is separate from stabilized. So 70 to 80% absorption for new leases. And that's a compounding effect. So we've had 21 straight months of negative absorption. All I mean by negative is if you deliver 1,000 units based on our data, about 750 of those are being absorbed. So
Right.
you're compounding additional excess inventory
Right.
every month. So we believe that it moves consistently each month depending on absorption, but based on that T6, T12 trend line, historical data, and understanding what we think demand's going to be and what it is now, we really think the bottom will be Q1 of 2026. You will have 15,000 units of excess inventory sitting there, which is a year to a year and a half of inventory that we typically would have for Phoenix based on demand. So that's kind of okay, we get to 15,000. Occupancy will certainly bottom right after that.
Okay.
And then you'll start to see a trend line where that excess inventory gets burned off. You'll start to see absorption as deliveries drop. Absorption starts to go above 100%. So now you're absorbing, say, 300 units, but delivering only 100. So you start to catch up and burn that off. Well, it's going to take some time. And what people don't realize is that today, if you look at the excess inventory, 52% of it is in the West Valley, so west of the 51.
They've had the most delivered.
That's right. Yeah. So, and still today, about 48% of that is still the West Valley under construction. So
Right.
the pain is really isolated in that area, the severe pain. We're going to suffer everywhere else during that time frame. But as the market heals past Q2 of 2026, you'll see the traditional strong submarkets in the East Valley, predictably, Tempe, Chandler, Gilbert, Scottsdale, North Scottsdale. Those will heal faster. and they'll look like a different market as you transition into 27, like early 27. The West Valley will still be in some severe pain.
Sure.
And then heal later. So optimistically, I hope that they'll rise together, but I think it's going to be a phased recovery.
You actually answered the next question.
Good.
I was about
I jumped ahead.
Yeah, you just don't want to
trying
hear
to
me.
save you
Well,
work.
you didn't want to hear me talk. It's okay. So we here at Mark Taylor, we look at the full Phoenix market and we break it up into 10 super group, 10 sub-markets, right? And that was the question is, with 30,700 plus units still yet to be delivered as we're tracking from now until the end of 27, which of those, find the most resiliency? And you mentioned it's North Scottsdale, and just following that 101 and even the 60 and the 202 out to the east side of town. So let's talk replacement costs, right? Are we seeing and witnessing a shift from developing to acquisition being a better, more attractive to investors?
I mean, you'll see, depending again on the deal, and this is what's flummoxing, I think, acquisition folks. I talked to my buddy Dylan the other day, and it's just like it's hard to get your arms around what's a good number and what is actually replacement cost versus current in-place acquisition costs. And I think the struggle is, you have to get into the details. Is it a garden style? Is it a mid-rise wrap? Is it a mid-rise podium? Is it a high-rise? You're seeing some deals trade still in the $400,000 range, but if it's a wrap, maybe you could say that's still above development or replacement costs. But you see some garden styles trading at $220,000 a unit. That's basically Class A or below replacement costs. So where does that, usually you see, it's almost all 95% here or 95% here. So I think you're going to see as the absorption starts to pick up, hopefully, even though the excess inventory is growing, that'll offset that, and there'll be a trend line that looks positive, and you'll start to see more folks say, okay, I feel like, recovery's here. But you're going to have some people that really are focused on, okay, I know this deal makes sense for me. I understand the demographics. I understand the submarket. You have to be precise and buy deals the right way. So I just don't see the 252 transactions we saw back in 2022 happening again anytime soon. But you're going to have to find specific deals and fit it within your investment thesis.
We're seeing a little bit of uptick on capital markets, but not significant enough to really.
Yeah, 7 in April, 8 in May. Little tick up.
Little bit. So
easy to tick up when you're at 1 or 2 a month.
True. Yeah. Only one way to go. So we talk about how important location is for real estate. That's always been the case. Sure. Location. What do you see that really separates a new deal right now, a new developed deal, that really sets it apart from anything else that's being built? Right? We have traditional garden for umpteen years, right? We have some beautiful high-rise product still being developed down in downtown Phoenix, mid-rise, just wrap, podium, beautiful, just gorgeous. Give me something that's really standing out to you from your purview.
I think it's just quality of build, quality of construction,
good bones.
And what's it feel like? It's no different. So if you own a home or you've toured homes, open houses, how's it feel? Like the design collectively with the construction, with the FF&E, you tie that into what's the team like, the oversight, the management, what's that quality like? So do you feel like you're getting a 5-star experience? And then what's the living experience like? Is the quality truly quality when you move in? So I think if you can combine those things, those are the folks that will separate themselves. Yes, price matters and concessions,
of course,
but if you're pounding away like the Avery just got another great 5-star review, 80 reviews at 5 stars. They talk a lot about the team and the 5-star reviews, the quality of the product. Those are things that are magnets or attraction mechanisms for other quality renters, and that will separate you. So my concern would be for, the 1 and 2 bedroom BTR, kind of 1.0 model that we started in 15, 16, 17. And now there's models 2.0, 3.0 with great amenities, different spaces. I see a shift there. So
Sure.
Can you fix those? No, you can run it really well, clean, great
Yeah,
management.
there's still a place for it in the market.
Absolutely.
It's just smaller piece now.
That's right.
Yeah.
So, but that's the majority of the units in the West Valley.
Yeah,
So,
exactly.
So, I think it's always great to have a different mousetrap, but you got to run it the right way.
How much does the amenity space in any deal play into the attractiveness or having it stand out? Like podcast rooms. We're going to be going on the road, by the way, Mr. Carlson. Did you know this?
Forge Towers
And the Statler.
And the Statler, yes.
Yeah.
Avery's sister, yeah.
Yes, yes.
I think it's, kind of what's in right now.
Sure.
Maybe there's a place for it. I think it's always good to have those type of rooms. You can repurpose them. You can use them. But just from an amenities perspective, it's two things. It's marketing, right? So can you fall in love with the asset when you tour it? You go look at a pool and a gym that you might never use. I'm still trying to figure out a way to get the data on how often those are used. FOBs, residents, friends, non-residents.
They're still new.
And then the usage, right? So if you build, an extensive amount of amenity space, now you got to maintain it. So I think that's where things get lost. And developer has a mindset, designer, we're going to do this, and then the management doesn't meet the needs of that space, and it kind of just falls apart all at once. Because if you have a massive space, it can go negative quickly if you're not maintaining it the right way, and that includes
Makes sense.
If you have 17 treadmills, they need to all work.
Yeah, true.
So amenities matter. For sure, specifically if you don't have a pool or you don't have a fitness center, those are going to be concerning. Those are the two anchors in my opinion.
Yeah, two anchors.
That's historically been the case if you look at the data, resident reviews, and feedback.
True. Last question for you. So I'm not going to give you a year. I'm going to ask you the year. We talked about job growth. We talked about just the attractiveness of Phoenix as a whole, corporations, business owners, et cetera. Jobs is a big piece of apartment demand, as we know. Given the amount of units, let's just Phoenix as a whole. Let's not talk a specific submarket, but Phoenix as a whole. Do you see a time where we find a little bit of equilibrium or close to it? How far out is that in your opinion?
I think it's submarket specific. So again, back to my original answer, you're going to see the best of the best submarkets with the better product or best product and more of it heal faster. And then you're going to see, demographics gravitating towards those areas. If it's an affordability play, they might go to a submarket that has more concessions, maybe more supply. If price isn't an issue, they might continue to go to North Scottsdale, Old Town Scottsdale, Tempe, the nice parts of Gilbert. In terms of, I shouldn't say nice. Gilbert's great overall, but
that was hurtful.
The
by
new,
the way, I'm
the
just
new
gonna say that
development
out loud.
parts of Gilbert. There's really no bad parts of Gilbert, as you know. But
I know. I'm teasing you.
I think it. All of those things factor in. School districts, of course. So we'll see. I think I just rely on the data and what we've seen in the past, and I think it's going to be East Valley first, West Valley second.
That it doesn't lie. I kind of like this new setup that we have going here, where I don't talk. You just do everything.
Well, let me give you a
No.
question.
We don't want any questions. No, we don't want it.
I got a question for you.
We're going to ask what you're grateful for.
No, I have an actual question.
Okay,
So,
what's your question?
So Adam, as most of you know, he runs our new business platform. In conversations that you're having, most often and currently with potential clients, groups saying, we want to come in and consult with you. What are you seeing in the market? All of those things. What's their sentiment? And then kind of a secondary question. If you go back 2 years, how has that changed? Like, is it significantly different in terms of the mindset around Phoenix, what they're thinking?
Sure.
And from an investment perspective.
Well, let's go back 2 years. 2 years, it was an absolute. The funnel was wide open. Everyone was just coming and asking questions. Different submarkets, a lot happening. West Valley, as you already mentioned. Now we're seeing even traditional developers coming to us looking to acquire deals that they've never done before in the past, right? So you do see that a little bit of that shift. Still very bullish on Phoenix. And for every reason that you mentioned at the beginning of the episode here, they just love the feel and what is happening. There's just too many opportunities here in the Phoenix market still, even with the oversupply happening right now. So, yeah, we love that everyone has an eye on our market, our home, our backyard. So we're lucky to just be in a position to guide them in the right direction.
Would you say the topic or concern around water has subsided a bit?
I don't get that very often. Good. After that episode with Greg Vogel, I think that was a big one too. But I mean, he of course educated us that much further, but we knew exactly what we needed to know to share with our clients.
If anyone has any concerns around what we have from a water access and availability for Arizona long term, go check out our podcast previously done a couple months ago. That was great. But Greg Vogel, Multifamily Forward, just do Greg Vogel,
Land Advisors,
Water Issue Arizona on YouTube. There's some great shorts in there. So yeah, check them out.
Your mind will be blown. Thank you, JC. Let's finish off.
Okay.
What are you grateful for? Don't look at mine. You just looked at mine. Don't
did not
cheat.
Look at yours.
Do not cheat. What are you grateful for today?
I don't have to look because your font is so big.
You can see it from across the room. What are you grateful for today, boss?
Today we are going to execute our lease on HQ3, so I'm excited about that. I won't share any details, but that's happening.
Brian almost fell off his chair. You just almost made him fall off his chair.
Well, and by the time this airs, it'll be done. I think what I'm most grateful for is in thinking about, because this will happen in February of 2026. I'm excited to have everybody under one roof, because I feel like when you separate a culture like ours, when you separate, you're basically splitting the head of everything. And I just want to have the team back together again. And I'm really excited. We'll probably play that song.
Oh, absolutely.
But I'm excited about, I'm visualizing, which I do often. My wife does it too, but visualizing walking into that space for the first time with clients, with our employees, sitting in a large conference room, going down to the atrium to grab a coffee, sitting on our patio deck across the atrium. I mean, all of these things I've been thinking a lot about today. So I'm also reflecting on the time we spent in these two buildings. This one was short, 3 years plus. HQ1 though, almost 24 years. So excited for
amazing
next generation.
History.
Yeah,
that's great.
What are you grateful for? Give me something.
I'm going to give you something. Well, one, I want to go back because this is very exciting. Moving HQ1, HQ2, now we've got HQ3, right? And being under one roof is going to be pretty cool. I think about this because we're so on top of each other here, because lack of space and because of our growth, mindful growth. Does that change the culture in any way, do you think? Like me being able to yell and scream at my team with all of them in the room where I actually don't have to raise my voice at all. And I don't yell and scream. You know that. I'm joking. Think that changes in any way?
Well, that doesn't really answer what you're grateful for, but I think... Sorry, audience. No, I think how we section it off, how we interact. I mean, everyone's in the kitchen.
Thoughtful
everyone
how you designed it too.
So
yeah.
So it's. I mean, no, I'm not worried about that.
I'm pumped. That's not what I'm grateful for though. So what I am grateful for is Aurelio Rios. I know you're out there. Hopefully you're listening and you're watching. He is our manager of facilities and services.
He's a legend
out at Cityscape downtown Phoenix. I mentioned Apartmentalize. Aurelio was won the month of March through NAA, Arizona Multi-Housing Association, as affiliate of National Apartment Association, and he was the winner in the month of March nationally as a maintenance legend, which then gave him the opportunity to go to Apartmentalize and be the big time winner, win a truck, et cetera. I mean, just for him, because this is our first and only maintenance legend, not just Mark Taylor, the entire state of Arizona. The entire state of Arizona. So I'm grateful for Aurelio.
Yeah, and it wasn't hyperbole. Like, he is a legend. So congratulations to Aurelio and
fantastic
his team. And I know he shares a lot of gratitude towards Shelby, his manager. Fantastic manager. Yep. And so I appreciate both of them.
Thank you again for being here with me, my friend, as always. We're going to go that way?
Pound it.
Did we do it the wrong way?
I don't know.
We'll have to actually go back.
I can't do
Probably
like the,
not. Yeah.
that's
no,
weird.
That's
Yeah,
too. Okay.
yeah.
Well, thank you for joining us again. Multifamily Forward, presented by Mark Taylor Consulting.